Well, hello, everybody. Welcome to Conversations with Cobb. I'm Mike Cobb, Chairman and CEO of ECI Development, and really happy to have you all joining us this evening. We're going to take a couple minutes and let folks sign in. I know it takes about a minute to 90 seconds sometimes for people to be able to come into the Zoom application, especially if the softwares have to download. But I do appreciate everyone being here on time and coming in. We're going to start promptly in about another 60 seconds. In the meantime, what I always like to have folks do is type into the chat or the Q&A section your location. Where are you calling in from? Where are you dialing in from? Where are you listening from? We always like to see what folks are here, and we know a lot of you, and we appreciate folks that are coming back again for another conversation with Cobb or another webinar. And also, it gives you a chance to look at the Q&A section. We will save the last 15 minutes of this webinar for your questions. I've got a great couple of folks here with me today. We're going to be talking about self-directed IRA and also a 1031 rescue program that I'm very, very excited about. I think it's truly an exceptional product that you're going to hear about today. It's not something that we've ever talked about before, so you all will be the first to hear it. But please take a moment, just type in where you're listening in from, and then also please make note that if you type in your questions during the presentation, the last 15 minutes will be reserved and set aside to answer your questions. I've come up with some questions that I'll be asking to kind of get the conversation with Nathan and Amanda started today. And before we actually jump into it, let me just read a quick bio for both of them so that you can get to know them. These are two folks that I've known for quite a while now. Nathan and Amanda have been to Nicaragua a couple times. They're actually, Nathan is building a home at Grand Pacifica, so it's very, very exciting. And he and I and Amanda and a couple of their clients were able to tour around Nicaragua for a few days earlier this year. We had a ball. We did things like climbing the volcanoes and staying in the colonial city of Granada, and obviously out at the beach at Well. The thing that Nathan is truly, this man is a tax master. Only 1% of all of the tax advisors have a certified tax specialist, a CTS designation. Nathan is one of them, only 1%. And so this is a guy that really has studied a lot about taxes because he cares about protecting you and alleviating folks from a high tax burden. So Nathan, really happy to have you on here today. Amanda, you're joining us, and you're actually an insurance broker, and you've done a lot with international real estate. You're spending a lot of time overseas. You do a tremendous amount of work both in the residential and commercial space, so knowledgeable in that. And between the two of you and what we're going to be talking about today with the self-directed IRAs and the 1031 rescue program, you guys are absolutely qualified to give great counsel, great advice. Welcome to the show. Happy to have you guys.
Thanks, Mike. I don't think I've ever gotten a better introduction before. That was very kind.
Yeah, we should hire you for PR. Thank you, Mike. We appreciate it.
Absolutely. You guys are rock stars, okay? I mean, like, it's just it's awesome to have you here. And because we've spent time together, both, out there with you in Fort Collins, but down in Nicaragua as well, getting to know you and getting to know your expertise, it's tremendous. And again, what you're going to be sharing with us today, extremely important information and great ideas, right? Great concepts and great ideas. But before we dig into those, please, I'd just like to have you tell me how you even began to think about international real estate. Because again, domestic is one thing, and a lot of people stay in that box, but you guys, you went afield. How did that even happen?
Well, it's not exactly a straight line. It was a series of events, or the domino effect, if you will. So Amanda's probably has more expertise in evaluating deal sheets. I just kind of jumped in and started buying real estate in 2008, and then just accumulated the rent and kept adding to the portfolio over and over in the residential market, and everything was pretty hunky-dory until a certain situation happened a few years ago. and there was a moratorium on evictions. And I had this tenant that was on Social Security disability, meaning her income was not affected by the situation going on. Like, she didn't lose her job or wasn't, not able to go into work. Her life was normal, and she's getting Social Security disability, but yet she got awarded, the moratorium on evictions and just subsequently stopped paying rent for 6 months. And I remember all of my friends coming up saying, well, why can't you sell the house? Or why can't you get her out? And I'm like, you don't understand. Nobody's going to want to take it with a squatting tenant. And I can't get her out. It's a federal, injunction, if you will. And I finally did get her out, and she racked up some $30,000 worth of damage. And I was like, look, I thought America was the safest place to own real estate. It really spun my head around. And, we had run into a lot of clients that said, yeah, we bought that mountain house in a ski condo 20 years ago, or we bought that lake house 20 years ago, but we never met anybody that said they bought it last year because prices are too high here. So you like Mexico. We started looking at Mexico, and tell us how the math worked out there.
Yeah, so I think this was back in 2019 and the start of 2020, looking at Mexico after this issue had happened. And it was kind of the same thing, looking at Cancun. Okay, everything's really overvalued. Same thing with Cozumel, just really expensive. And then finally finding some properties, but they were like 16 blocks off the beach, and there wasn't really a lot of stuff around it. And that was more of like a 9 cap. And so, we didn't have a property management team down there. We didn't know anyone down there. And it just became a problem. And then I remember coming back and looking at Colorado or even Wyoming for real estate. It's just like we couldn't find the cap rates that we were truly looking for.
Right.
So then, of course, you got on the internet and kind of started doing searches on, well, we found out Mexico, you didn't own title to the land. And that was really important to us. So Nathan got on the internet and said, what countries do you own title right on the coastline? And Nicaragua popped up.
And then we get into the the topography. Like Mexico, I think would get boring after a while. Like you can only dive so much or snorkel so much. And then Nicaragua's got these rolling mountains and these cloud forests and rivers and fishing. And you could scuba on one side and surf on the other. And this huge, vast, what do you guys have? 3.5 miles of beach. And I was like,
Yep.
in the competition, like in Mexico, you're competing for vacation renters against thousands. And like, I don't know, what do you got? 22 beach houses being built. And that's 22 houses competing for vacation rental dollars. It's like, that was like a gem. And to let you know how analytical we are on math, I signed the contract and put a deposit down before I ever set boots in the country.
Yeah, we did extensive research into your guys' financials, all of the rental proposals that you had sent over, and just we were blown away by the cap rates. And then also, of course, the rental management part was huge to us. It's
turnkey, so you definitely have a good thing going, and we're happy to be there.
Well, thanks, guys. And you know what? You did do your homework. I remember you kind of drove me and a few of my folks crazy with a million questions. But good for you. I mean, good for you. I wish more people ask a lot of questions, right? I think the due diligence piece of the process is critically important, and you guys really did do it well. The thing that's interesting, and I don't know how well folks can see this little, I call it the popularity chart, right? But you guys understood this very, very well. Amanda, you said, hey, look, the cap rate's up here in a place like Mexico. I got to pay a lot of money for the property, and the cash flow's good. I mean, because it's popular. I mean, Cancun, Mexico, very popular, right? But by the time you factor in what you have to pay for the property versus what you're going to earn in rental income, the cap rates are low versus a country like Nicaragua, where it's not very popular. So your cost of acquisition is so much less, right? But you ran those numbers and you figured that out. And I think that's a powerful analytic understanding that you were able to bring to the table here.
Yeah, and the other thing, I think this is one of the things you kept bringing up, is if you buy domestically from a developer, the price is not locked. It fluctuates with labor and materials. And that was one of the things that was super unique about your organization, is if you drop the 50% down, you guys go buy all of the hardware and materials, we lock out material inflation, and you ride the risk on labor inflation. And I actually know what my final turn cost is going to be.
That is correct, right? And and again, the reality of that is certainty for you, the buyer, the consumer, right? Which is what you're looking for when you're making an investment. The more certainty you have, the better. Yeah,
For sure.
so okay, so I know that we're going to talk about two things tonight, and we're going to wade in right now. We have this the 1031, which we didn't talk about so much. We talked about this as a self-directed IRA webinar, and so I want to stay on that first. I want to talk about self-directed IRA and how folks can use it, and then we're going to move over to the 1031 exchange program. I'm not sure. Are we sharing screens? I saw us move.
No, it's just a conversation. We just did, we saw the main slide and we're just like, let's just talk between
right.
us.
Perfect. Okay. I'm watching stuff happen. I'm like, I don't know what's happening, but it's all good. So, let's just start real simply. And this is sort of a theoretical question. Why do you think that most people don't even imagine that they can use their self-directed IRA for something offshore? What's behind that? Because we know they can, people do, but what's holding people back? I think that's an important, I don't know, a concept that we need to get our arms around.
I mean, maybe I'm a bit pragmatic or jaded, depending on how you want to look at it, but I always say follow the money. So like the vast majority of retirement accounts are controlled by what I call the Wall Street firms, whether that's Fidelity, Schwab, Ed Jones, it doesn't matter to me. And those people make their living off of what I call passive investments, stocks, bonds, mutual funds. They're not financially incentivized to tell their clients, hey, look, did you know you could buy gold and silver or real estate in an IRA? They're just not incentivized to tell you that. And it's just not common knowledge. Amanda and I have Independence Money, if you want to check us out on YouTube or on Rumble or on Spotify. And we often hear people say, man, I wish we would have met you guys 2 years ago. I actually cashed out of my IRA and paid penalties because I wanted to go buy real estate. I didn't know you could buy it inside. And that's really was our driving factor with this masterclass, is to tell people it is doable. It's perfectly legal. There's some rules that have to be followed.
Yep. And we're gonna get into those rules. In fact, why don't we talk about those rules? But before we do that, you hit the nail on the head, and I think that was an important piece of the puzzle for folks to understand, because the IRA business, let's just call it that, the IRA business is 95% or 98% driven by these big stock brokerage Wall Street firms. They have no incentive to let anybody know that they can do something different with their money, right? They want to keep the money in-house. They want to earn the fees, commissions, and those kinds of things. And so they've done a great job of putting up this big screen between, the IRA, generally, and what a person can actually do with it. And you guys have, and that's really what I wanted to bring up. So you guys have opened this conversation up for so many people now, because, again, it's just not something that's common knowledge. And the really cool thing is later in the program, we're actually going to talk about another thing that you've opened up in a way, that a new concept that you opened up that, again, is not something that people would ever think about, but is powerful. But let's stay on the IRA, self-directed IRA, for a minute. What's the difference between a traditional IRA and a self-directed IRA? And then let's move into sort of the rules and regulations that we have to be very, very careful about.
Well, I'll cover the taxes and you cover logistics.
Perfect.
So we're going to say IRA or retirement account, but what we mean by that is it could be a traditional IRA that's tax deferred, and then in retirement you take money and it's taxable. The Roth is tax free when you take money out, and then there's the solo 401k. So if you're a business owner and you don't have employees outside of the owners or the family, you could do a solo 401k, and depending on your age, you could contribute up to like $63,000 a year into that code. All three of those can own real estate, and then I'll let you handle.
And in addition to that, if you have a 401k, most Fortune 500 companies, if they have a provision in your 401k that if you're over usually 50 or a certain age, that you can roll your 401k to an IRA, and then you can also invest in real estate that way. So
while still employed, meaning you can do a rollover without having to lose the job. And we know how to call those custodians with you guys if you want to reach out to us directly. We'll ferret through that as well.
Yeah, so on the logistics part of it, usually your regular IRA is going to be with one of those big Wall Street firms, Fidelity, Charles Schwab, whatever. But what's going to happen if you want to invest in either precious metals, real estate, or anything specialized, you're going to have to do this with a qualified custodian. So none of the big Wall Street firms are going to be able to do this. We work with a bunch of different ones, or you can just find one if you already have one. But we're going to have to set up an LLC portion of that to get then your IRA then buys the shares of that LLC, and then you can buy the real estate within that LLC.
And I've heard the word checkbook IRA thrown around. Can you flesh that out a little bit, please?
Yeah, so dealing with an IRA custodian is complicated. They limit what you can buy, right? So just like your IRA at the Wall Street firms will allow you to buy Walmart stock, it's kind of the same thing. We move the IRA from the Wall Street firm to a specialized custodian. That specialized custodian incorporates an LLC on your behalf that your IRA then buys all of the stock of that LLC. And then from there, the money leaves the custodian to a checking account. Mine's at Wells Fargo. So Wells Fargo has no idea that that LLC is owned by an IRA. They just think it's any other LLC account. So they're not going to give me any pushback on what I buy. And then from there, I can write a real estate contract in the name of my LLC that the IRA owns, the same way you would buy it in a taxable LLC. And then you get your contract accepted. You lay out the cash outlay. The title is in the LLC's name. The rent goes into the checkbook, and it flows up the chain to reporting to the IRS that none of this is taxable because it's owned by an IRA. So it's a lot less complicated when you think about the fact that end of the day, you have a checkbook. You look like a cash buyer when you're buying real estate because you're not having to deal with a mortgage. But that's a key misnomer a lot of people don't realize. You can use a mortgage. There's just rules on it. It's called a non-recourse loan. So what does that mean? They're not pulling the owner's credit. They're not using your FICO score or your earnings or your net worth. The house has to stand on its own 2 feet for being able to get a loan. That's what non-recourse means, is if you were to default on the loan, the lender could only go after the house. They can't go after you. They can't sue you. And as a result, most lenders are only going to lend 50%. But you can use leverage and if you have a $250,000 IRA, you could buy a $400,000 beach house and then use the rent to pay that loan down and then rinse and repeat and start all over.
There you go. That's right. Now let's talk about a $400,000 beach house. There are rules when you're inside a self-directed IRA that prevent self-dealing, disqualified transactions or whatever they're called. Explain that, because I think that's where a lot of times people do kind of get tripped up or confused about what they can and cannot do. So
Yeah, so that's the unfortunate part is, you referred to self-dealing. So you yourself cannot benefit from this transaction. So you will not be able to stay the night in the house, nor anyone on your direct bloodline. So your parents or your children, but your uncle, your cousin, or your brother could stay there and rent it. So unfortunately, that is the case. And additionally, a lot of people think, maybe I have a $250,000 IRA and that's it, and I want to go buy this beach house. A lot of people don't think about having cash on the side to make sure that they have money for repairs, or if anything happens, like they need to fix something that a tenant breaks. You have to have cash within that IRA to pay that. You're not going to be able to pay that out of your own pocket.
Exactly. And I mean, the whole point of it is that an IRA is to be an investment. And if it's an investment, you can't use it. So again, thank you for that very succinct explanation. It's something, again, that people don't always think about. The cash, having cash on the side to be able to write a check for things that get broken or repairs, that's right on the money too. And before we come off the self-directed IRA owning real estate, is there anything else on this particular topic that you'd like to bring up before we switch gears and go someplace exciting? I mean, not that this isn't exciting, but but we're going someplace else exciting. So
Yeah, some people call me creative, and some people would say it's complicated. So you can take it as you see fit. But let's get creative here. So let's say
all right,
Amanda owns a beach house in her self-directed, and I own one in my self-directed. It's fully permissible, since we're not bloodline related, that I could go rent in hers and she can rent in mine, as long as we're paying fair market value rent. That's perfectly permissible. Another thing would be, let's say people are following your organization, but they're tied to a job, meaning they're not one of them, Generation Zoom. They have to be, at their company every day. And their long range goal is to have retirement in, say, NICA or Belize. Let's talk about that. So let's say they take the Roth route, they buy the house in the Roth, and then they hit 59 and a half. They can distribute that house outside of the Roth. It's not a taxable event. It's, they're 59 and a half, so there's no 10% penalty tax. And then they can stay in it all they want.
so let me flesh that out. So somebody in their 30s says, you know what, I want to buy a home, or I want to buy a condo in Belize, right? And they're 30, and so for the next 29 and a half years, it rents, it generates cash flow, it pays a mortgage back, blah, 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 blah. It does all that stuff, and then when they're 59 and a half, they can distribute that condominium to themselves and go live in it in Belize.
Yeah.
Okay. I mean, that's tremendous, right? I mean, and that's using the Roth, right? That's using the Roth
Correct.
mechanism.
If that was in a traditional IRA or you used 401k money, when you distribute that would hit your normal income tax brackets.
Right. But because you're taking post-tax money into your Roth, you have the ability to pull it out tax-free. So
correct.
Yeah, and because it all flows up to the Roth, you don't have to convert. If you start off on the IRA, you don't have to convert it all to a Roth in a single year, thinking the house is the instrument. The LLC is the instrument. So let's go back to a $400,000 beach house. You want to convert 25,000 of that a year for 8 years to get that to be a Roth. That's totally fine too.
Well, that's interesting. So you keep your tax burden on an annual basis at kind of a lower level. Yeah. Okay. Yeah, good strategies, guys. Great strategies. All right. So here we go. Now, you guys, and this is tremendous. So I was at NAR. I did a class with the National Association of Realtors. It was a certified international property specialist. It was an invitational class in Chicago. They bring in the future leaders of the National Association of Realtors to come to this invitational class, and somehow my name got on the list. I didn't correct them and tell them I wasn't supposed to be there, so I went. And I remember one of the things that we talked about was 1031 exchanges, and the instructor brought up the fact that you cannot do a 1031 overseas. And I said, well, hang on, that's not really true, because 1031s are like-kind exchanges. You can do domestic to domestic, you can do foreign to foreign. And they made me fact check it, and I did, and showed the class. And I'm like, yeah, actually, if you have money built up in a foreign property, you can 1031 it to another foreign property. Same thing with the US, but you can't crisscross it, right? And so now you guys, I mean, this was a conversation we had, I don't know, earlier in the year. You guys have figured out a way, not in the 1031 mechanism, but something that allows money that's been built up inside a domestic 1031 bucket, let's just call it that, to be utilized for a property ownership overseas. If I've said that wrong, correct me. But we're going to wade into it because it's such an incredible concept, because so many people have been buying and selling 1031ing, and now all of a sudden there's this big jackpot of money that when it comes out, it's got to pay a lot of taxes on. And to the extent that we're able to do something that we want to do with it different, that's powerful, guys. So did I say it right? I mean, it's your recipe. Let's hear it from the horse's mouth here. I'm excited. I hope everyone else is excited as I am to hear about it. So
yeah, that's great. Yes, we do have a strategy to fix that. With anything, the government writes the rules and we get paid to teach people how to play. So we'll kind of go through some of those details here at the tail end. But I want to spend a few minutes kind of setting up the problem. So let's start with like,
Okay.
what is a 1031?
Yeah, so whenever you sell an investment property, so if you have a residential rental property in the US and you might you want to work your way up and now buy a $500,000 residential property, and let's say that was 200,000. Well, you don't want to pay the tax on the gain right now. So there's something called the 1031 where you can just transact into that one and then defer the tax into the future when you want to realize that tax. So do we want to kind of go, that sounds really good right now. And I think a lot of real estate investors are really myopic on their tax timing, as we call it. That's kind of a later problem. Right now, I don't have to pay the capital gains. So that's a future me problem.
Future me problem. Remember, Jackie, future me problem, right? So, yeah, I mean, I think real estate investors can get a little bit lackadaisical saying like, this is a no-brainer. Why not? Why would I ever want to pay the taxes now? So here's a couple problems I see is one, we are at an all-time low in tax rates. They've been trying to raise them as early as next year. And even if they don't succeed, they're going to go up without a vote of any Congress in 2026. So right now, our rates are extremely low. 35%, 33% of the time in our US tax code history, the tax rates have been 35% higher than they are now. So first off, out of the gate, are we deferring taxes from a low tax environment to a future high tax environment? I can make the case that that is going to happen. The second thing is the 1031 requires you to buy more, including the leverage. So if you start with $250,000, principal you contributed, you borrowed $250,000, we're going to call it $500,000. When you sell that for $750,000, you got to buy something more than $750,000 to defer those gains. Well, then you end up in commercial, and then you end up in multi-millions, and you're still having to use mortgages, and we're in a rising interest rate environment. So those deals are looking less and less attractive. So we've met a lot of 1031 investors that they want to sell, they don't want to book the taxes, but there's nothing to buy. And that's the ones you've sent us saying, hey,
yeah,
they recognize deep value of going overseas, but they can't hop the border.
or especially a lot of people that got into commercial property in 2020, and we saw the great migration of people working online, factories getting shut down, people not just working from home in general, and a lot of people on those commercial properties suffering because they don't have tenants anymore. And just it's really hard to get a really good cap rate, especially when you're in the multi-millions of dollars. And they just don't want to sell because they don't want to book all those taxes.
So everybody's heard of the Inflation Reduction Act, right? Those are what we call a little pocket legislation. They're picking a theme and they're passing it. But what happens every single year is the budget proposal. Because if they don't pass the budget, the country stops. And in 2023, they're actually voting on this at the first of next month. In 2023, in the budget proposal, we don't know what's going to pass. I'm just telling you what they've thrown in there for debate. They're talking about eliminating the 1031, which I don't think that's going to pass. They're talking about eliminating the step up in cost basis at death. So that's the main crux of the 1031 crowd. They call it swap till you drop. You just keep swapping until you die. You get a step up in cost basis. Nobody pays taxes. They are zeroing in on that as a tax loophole they want to close. And then what's scarier is they're saying they want to turn certain capital gains into ordinary income, which can go as high as 39%. That's going to be cataclysmic. And that would be a situation where you would have wished you would have paid the taxes, even if you didn't have a strategy we could talk about, because the tax rate in that case is over double.
Right. And I know you guys have done some research on capital gains tax rates over time. And why don't you just outline a little bit of that just to give some perspective to the comment you just made?
Yeah, so actually the average capital gains tax rate since 1954 was 25%. They're at 23.8 right now. But the average since 2000 is 20%. The highest capital gains ever was 40%. And now they're definitely looking at, making these real estate transactions at your ordinary income rates, which they're also trying to push to 39%.
Yeah, and if some of you really astute tax people thought you caught Amanda in a mistake saying, the capital gains rate is 23, and you're like, no, the maximum is 20. Let me explain. There's also taxes within taxes. So yes, federal maximum capital gains rate is 20, but then if you make too much money, then you tack on another 3.8 for the Obamacare
It's
tax.
also not too much money. It's only 250,000 filing jointly.
And that's not earned income. That's
Yeah.
earned income plus whatever you sold.
Correct.
So that's, 23.8. And then if you live in a taxable state, well, now we're up to 28%. And then you have states like California that are doing what they call clawbacks. So let's say you 1031 out of Cali to Texas, thinking Texas doesn't have a state income tax, and then you sold in Texas. Cali's like, give me my share.
Yep.
Well, what if that's worse? What if you 1031 from California to Colorado, then you sold it? That transaction is going to be taxed by Colorado and California on the same money, plus federal, plus Obamacare tax. I think the point we're trying to make is, with all of the money spending and printing they're doing, they're going to one way or the other come for higher taxes. So might as well sell at the high, go get a deep value in a beautiful location, and figure out legal tax strategies to mitigate and avoid some of that.
Well, you've opened the door. Walk through it, Nathan.
Yeah, you want to start with how the strategy works?
Yeah, so the basic idea is there's about a half a dozen different flavors of what we generically call a charitable LLC. So what you do is you probably own the property in a taxable LLC. We go form a charitable LLC, and you quit claim deed that over to the charitable LLC. That in an initial transaction is not taxable because you wholly own that secondary LLC. And then at that point, we do what we call fractionating the shares. So we turn the 100% shares that you own with 100% of voting rights, we fractionate those into two share classes, voting and non-voting. Now, you can do this 75-25, you could do this 50-50, or you could do this 1% and 99%. Let's go with the 99% example. So you have 1% of the shares are voting shares, 99% of the shares are non-voting shares. You donate those non-voting shares to the charity. Well, at that point, when you sell it, the K1 taxable distribution, 1% of that goes to you, and you pick up the capital gains tax, 99% goes to the charity. They don't have to pay taxes. Well, wait a minute, did I just give away my asset? No. The LLC does not go to the charity until the end of the donor's death, or for really control freaks, we can set this up to where it goes to the charity at the end of their kid's death, or their grandkid's death, or their great grandkid's death. And all the while, you're the managing member of those 1%, which means you get 100% of the decision-making. Charity gets no decision-making ability because they don't have voting shares, and they just have to patiently wait on somebody to kick the bucket. And in the meantime, you get to make all the investment decisions. So now you've sold domestic property, you have a big pile of cash that you've avoided 99% of the taxes on. Now you can cross the border and go buy international property in that same charitable LLC, and there you go. And you can continue to own that, or you can manage that and sell that and buy something else, or you can sell that and buy stocks or gold or whatever. It doesn't matter, but you're avoiding the long-term capital gains.
Yeah, and additionally, that also takes the asset out of your estate. So that's another thing that we've been looking at in 2026, when the estate taxes sunset back down to 6 million a person. That can be a huge income and wealth preservation strategy for people that have large amounts of wealth in their estate, and totally avoiding some states as well, like Illinois, that have inheritance taxes starting at $40,000.
Okay. So let me ask, let me just, so basically I'm going to take the value of my property in the US, I'm going to, or take the property, quick claim it over, then I'm going to sell it. I'm going to pay the taxes on the piece that I keep. The charity doesn't pay taxes, because assuming, now, do you have to get a 501c3 on this charitable company? How do you manage that so that the company itself isn't paying taxes?
Well, the 501c3 is an operating charity. So you're like, you've got board of directors and, you've got employees. So it's not a 501c3 because it's more of an investment LLC only. And
Okay.
so, there's some reporting that are done on various tax returns that get stapled onto your 1090, 1040 tax return, but it's nothing as complicated as a 501c3.
Okay. All right. So you've set this up, you've transferred the asset, quit claim the deed, whatever, you've transferred the asset. Now you take the value of that asset out, sell it, presumably. You pay the taxes on what you have to. You don't pay the taxes on the part that's in the charitable piece. Then you take the money that's in that and you go buy a beach house in Belize or Costa Rica or Panama, Nicaragua, wherever, right? Are there prohibited transactions? Are there things that you are allowed to do, not allowed to do? What's the relationship there once you've done that?
Yeah, great question. So there's two elements to this. There's income and then there's the asset. And in this particular design we talked about, the asset goes to the charity at the end of somebody's death, either the first generation or second or third or fourth, right? But then let's talk about the income. So by law, the income has to go back to the donor. So all of those rents come back into your pocket as the donor to support your retirement income. That's the rules, and it follows the tax code.
So, and you pay tax. So if you have a house in Costa Rica, you're renting it, the whatever, 15, 20 grand a year, that money comes back, you pay taxes on it in the US.
On the income, yes.
On the income.
So
yeah. Okay.
If you sell it in the future, you could choose to avoid the long-term capital gain once again, or you're entitled to take 50% of the long-term capital gain and subsequently pay the taxes on that 50%. So I think that's the stressing point, is normally when we put money in the offering plate, it's gone. Control is gone. In this scenario, you have full managing member control to make all the decisions, and you get the income. It's only the asset that we leave behind at death. And in reality, even outside of charity programs, we all leave everything we own eventually behind, right? So might as well get the use of it, the income now, and the tax favorability now. If you really want your heirs to have it, use the tax deduction to go buy life insurance. Then your heirs can take that life insurance at your death, go to the charity and say, I got a big pile of cash. You want to give me my beach house back? They'll say yes to that all day long, but you don't have to die. So let's say you've got $1 million of 2 beach houses in the charitable structure, and you got $1 million outside of the charitable structure. You could take that $1 million to the charity and say, here's that $1 million. Give me full possession of those properties back. You can buy them out. They'll do that all day long.
Sure.
Because you mentioned prohibited transactions. That's more stringent than the IRA. The IRA was just direct bloodline. In the charitable structure, it's anybody related. So aunts, uncles, third cousin, nobody can stay in it. If you violate the rules, it is bad. So just be aware of that going into it. But let's throw in another idea, Mike. Let's say you just sell the property in the charitable structure to get the tax deduction. Say you're in a 40% bracket, you sell $1 million, you save 400 grand. You take what you would have sent to the IRS and you go buy the beach house outside of the charitable structure and buy regular stocks and bonds in the charitable LLC, and then you get the best of all worlds.
Absolutely. The reason I brought up the prohibited is because it is far stricter on this particular program. So but I like how you thought about that. You said, look, hey, but you guys are creative. Look, take the 400,000 you saved, go buy yourself a beautiful property that you own outright. You can use it, do whatever, right? And then inside the charitable structure, do more traditional investments, or go buy another beach house for rental. Doesn't matter. I mean, you could still do that too, right? So it's right. No, but it's a brilliant strategy. I would say the only thing wrong with it is, you got to die to make it all work, but we all die. So I think that's all right. And let me just another practical question. You set this up, you say you're going to leave it to charity X, and charity X decides they're going to do something you don't like, or they go out of business or whatever. You can always modify who that final designee is, correct? You're not stuck when you make it.
Yeah, I'm so glad you made that point. So you initially, just like beneficiaries on any other account, you initially pick the charitable beneficiaries, but you can change those at your leisure all the way up to the point where you die.
Right, right. And I think that's also something that people worry about. Like, I'm a young guy. I'm not that young, 58, right? But I hope I got another 30 years. We'll see. I've been running this body at Redline about 8,000 RPMs for 58 years. So I don't know, but it's been a fun ride. Let me assure you. But in 30 years, a lot can change, right? So if I pick a charity today, I'm not really sure. So that has to be a very comforting thought to many people, that you can change the designee at any point up and until you pass. So that's good. All right. So it is 5:41. We have 4 minutes until we're going to open up for Q&A. Michael Fuller, I don't know if we have any questions coming in. I hope we do. And if not, and you're listening, please jump in and type some questions. There's been a lot of stuff thrown out here in this conversation thus far. You've got two phenomenal experts in both the self-directed IRA, this tax strategy stuff. These are your absolute gurus tonight, and I hope that you have some questions for them. But in this last 3-4 minutes, 5 minutes, whatever, what haven't we covered on either self-directed IRA or 1031 escape plan that you would like to put on the table here?
Yeah, I think the one thing we didn't mention with the 1031 rescue plan is that it is all asset protection. And I think that's one thing that a lot of people like, especially these days. You have international real estate mixed in there as well. It's just a great strategy overall, and also gives the investor full control.
Okay. Yeah.
I think that's a good one. I think if sometimes people are worried as Americans about reporting. If you own property in your personal name, the way that the laws, are structured now, you do not have any disclosure requirements to the U.S. federal government. If you own them in an LLC, whether it's charitable or regular LLC or a NICA, the SA, that becomes a financial account and therefore does have to be disclosed. But it's not that big of a deal. You hire professionals, there's some filing fees. You report that. We were on the phone with one of our tax attorneys today, and he's like, people think that if you report international, assets, it creates a red flag to the IRS. It's exactly the opposite, because they're going after these rule breakers. That if you're the one that says, hey, I'm following the rules and I'm filing correctly, they're like, we're going to go look over here for somebody else. You're on the good guy's side. So don't be afraid of that at all.
Now, and thank you, Nathan. That's a really good point. I think people do assume that when they're doing things overseas, offshore, that's a bad word these days, but overseas, that they become a target. But when you file properly, when you do the things that you're supposed to do, follow the rules, follow the regulations, you actually are, I don't know if you're less likely, but you're certainly no more likely to be audited or targeted than anyone else. Because look, it's a big world and lots of people are global, right? So just follow the rules, and you guys do, and you understand them, and to the extent that you understand them, great. But also obviously finding tax attorneys and international tax specialists who can help with those filings and reporting requirements are critically important. So Michael Fuller, if you can come on for a minute, and if we have some questions, or Nathan, Amanda, I don't know, can you see the questions? Are you able to see if we've?
Yes. Yeah.
Terrific. All right. I don't know. Read the question. Read the question, and then let's see where we go with it.
Yeah. So, will you be offering strategies for non-U.S. citizens? I'm a Canadian living in Canada.
Well, in full disclosure, my expertise is the American tax code, because it is by far and wide the most complicated tax code in the entire world. But we do have other specialists that we can coordinate you with that are familiar with the Canadian tax code. So directly with us, not at the moment. Indirectly, we have a whole breadth of other professionals. So, reach out to us. We will make that connection. And I will probably just stay on board and listen so I can learn from them as the viewer does as well. So thanks, Nelson, for sure.
Yeah.
All right, the next one. For self-directed IRAs, if you purchase a rental property and are retired, what happens to the rent money?
Well, it still would go into the self-directed IRA, but if you're over 59 and a half, you just fill out a distribution form and swing it to your bank account if you need to live on it, if that's what the
Mhm.
question is meaning there.
Or you have the option to also keep it in the self-directed IRA as cash, and that could be your kind of cash side account that you're using to make improvements or also repairs to the property. You don't have to distribute it, but if you are over 72, there are the required minimum distributions. So that is something to keep in mind, that if this is, you're buying this in your only IRA, that at some point you are going to have to fulfill those required minimum distributions.
So Amanda, let's stay on that point just for a second. I'm going to use easy number. You own $100,000 property overseas. You hit 72 and a half. Tell me how that, and it's inside the checkbook IRA. So it's inside an LLC. So you have shares. Tell me how that would actually work. I think that's a great thing to just drill down. $100,000, 72 and a half. What happens?
Yeah, of course, the IRS doesn't make it easy and just give you a straight percentage. It's based on an actuary table, correct? So it's very arbitrary, but it's usually around like 2 or 3% a year of the account value, right?
Yeah, it starts around 3% and change, and then it, I think maybe by 5 to 8 years later, you're around 5%. And then, if you're in your late 80s or early 90s, you're probably looking at 10 to 11. So I think the main thing there is you need to make sure you always have some operating cash, because it would be very hard to distribute 10% of a physical property.
Well, right. And so if you had it inside an LLC, you could distribute 10% of the shares or whatever percent they had, right? And if you didn't have cash in your IRA, you could pay the cash piece with what I'm called regular money, correct? Or no?
Now that IRA has to stand on its own. So I would say that's one of the major things you need to be aware of, is you need to make sure that, you've accumulated the rent over the years, or you have some other investments in there that are more liquid, like stocks, whatever the case, because no, you can't mingle that with personal funds, if I understood you asking correctly.
So, okay, well I did ask that. I said, basically, if you had to take out, $5,000 of distribution and you owed $1,500 of tax, that $1,500 would have to come from inside the IRA. It could not come from outside the IRA.
Okay, so yeah, if you had to distribute 5,000 and that triggered 1,500 in tax, you could pay the tax obviously out of pocket.
You could pay the tax out of pocket. Yeah. Okay, well, that was my question. So you're not really stuck, right? I mean, you've got cash presumably somewhere else, but you can distribute 5% or 3% or whatever that is over time and pay those taxes. So, okay. Right. But if because I could see how you could be really, truly, if you took the rental income over the years and every time you had a, some amount of money, go buy another property, you could actually build up quite a portfolio over time because you're not paying any tax on that rental income, right? So you're getting accelerated ability to acquire new assets, but you could end up being very land rich, cash poor, so to speak, at the time you 72 and a half and had to take distributions. But even then, it'd be a great problem to have, right? You distribute 3 to 5% a year, you pay the little bit of tax on that. And yeah, okay.
Here's a great question. What happens if I don't have enough money in my own IRA? Can I use my spouse's? I love that question. Yes, as long as it's similar structure. So if your spouse has an IRA for $250,000, you have an IRA for $250,000. I'll save the technicalities because there are some, but the short answer is yes, you can buy one property that's 50% owned by hers, 50% owned by yours. What's not allowed is if your wife has 250 grand in taxable cash, you've got 250 in your IRA. That is commingling tax codes. That cannot be done. But I think, now I know if you have $250,000 in your Roth and she's got $250,000 in your IRA, that can be done because they're both retirement accounts. So that's a good one.
Yeah, that's a great question. Yeah.
What else we got, Miss Amanda?
You want to do this one?
Yeah, so we have a partner and I have a connection in Argentina. We're thinking about buying a home for investments there. However, is that our first, either that or our first home in the US? Any advice on the choice? The world is your oyster. I mean, you could buy property anywhere. There's no restriction on where. That's what's really cool about that. Um,
Time limits.
is in the self-directed IRA, are there time limits similar to the 1031 requirement? I don't understand the question, Ralph. You can re-ask it. The only IRA time limit I understand is if you take it out prior to 59 and a half, there could be a 10% penalty. And on the traditional IRA, there's that 72 age requirement for minimums. On the Roth, there is no required minimum distribution at age 72. You don't have to take a dime out of that until you die and let your heirs deal with it.
That's a nice way to look at it.
Yeah, so this one is I guess range of experience for setting up and maintaining these kind of structures and like kind of describing fee structures. I mean, yes, these structures, yes, they cost money to set up. And that's why we usually do consultations with people before we just go putting these structures in place willy-nilly, is making sure that, the long-term capital gains or state taxes and federal taxes that you're saving by deploying this strategy are much, much less than the cost, or much, much more than the cost of actually deploying the strategy. We say we want to put, if you pay us 5 cents, we want to go put, $1 back in your pocket, obviously. And there are attorneys and accounting fees as well. So.
I mean, that's the sweet spot of what I do for a living, Mike, is if you hire me, yes, it costs fees, but it's a fraction of what you would have paid the IRS. And I think of a little bit nicer than they are. So.
Uh-huh. Yeah. Well, and you open up some really incredible opportunities for folks that again, nobody's going to tell you about. I'm not saying nobody, you guys are, but very, very few people talk about these kinds of things. And right. I mean, if it's at a fraction of what you would be paying in taxes, what a great offset that it really is. Yeah.
This guy's asking what our range of experience is. I think at the beginning I said I started in real estate in 07, 08, and I started right out of the gate buying them in my Roth. I actually owned stocks in a traditional IRA, and then when I lost so much money with the stock market debacle, I converted it at the low to a Roth, and then bought the real estate also at the low. So I've been doing this for so long, and it's just like, as of late, it's like so many people are asking questions with the concern about the stock market and the domestic real estate. We started being a little bit more vocal on bringing these solutions to, the end user. I think that's a good question. Thank you for that. Yeah. So anything else you think about?
Yeah. Is there a minimum amount of investment to utilize these strategies?
For the self-directed, not so much, or the solo 401k, not so much. For the charitable structure, because of the attorneys and the charity involved and the tax forms, they're kind of looking at $1 million on that, which, if you're on a 1031 for any number of years, you're probably crossing that line. And that goes with this other question, what about selling my business? So yeah, if you own a business and you're wanting to sell that business, we can do the same charitable LLC. You sell the business in the charitable LLC, you avoid the long-term capital gains, you turn around, take the cash and go buy whatever you want.
Mm-hmm.
So it's not limited.
And inside these structures, this is kind of one of the things where you can commingle investments. So let's say you have a residential house that's now worth $750,000. A lot of people either kick in taxable stocks or cash that they have on the side to get to that $1 million. And you can have multiple investments over time. You don't have to just have real estate at one time to get to that million. You can have a myriad of investments inside that structure.
Okay. Any other questions, Amanda?
How many foreign properties do you own, Nathan?
Me, currently Nick is the first one. I got permanent residency in Mexico, and I've got a little bit of business in Caymans and St. Lucia and Puerto Rico. I just look at diversification as like, look, that's got to be across borders. Like if you own stocks, bonds, real estate, precious metals, cryptos, and it's all in the United States, I don't really think that's all diversified. I think you've got to be a little bit international, and that's where the fun stuff is.
I mean, we had a blast there.
I was gonna say, you guys have had some fun. and I know Nicaragua scares a lot of people. You guys know I lived there for 14 years, and I think a lot of it's just really, really bad public relations. And a lot of it's, fostered public relations, anti-Nicaraguan. But hey, look, there's the world, like you said, the world's a big place. It's the oyster. If another country fits, but having some of your assets outside your home country is absolutely prudent and wise. I know you guys are. I am. Many of the folks who've joined us tonight, I scanned the attendee list. I actually recognized about half the folks on there tonight as names that I've seen or met at various conferences over the years, and I know that you all are adventurous folks, and you are understanding the need to diversify outside your home countries. And Nathan, Amanda, I really appreciate the strategies and the ideas that you've offered up here today to help folks be able to make that a reality in ways that they may not have thought about before. And that's exciting. We're down to the last couple minutes. Any closing thoughts, any ideas or last words of advice or counsel that you'd like to offer?
I got two questions, one for Amanda and the last one for you, Mike. So Amanda, if they want to reach out to us or connect with us on the web or social, how do they do that?
Yeah, so you guys feel free to email us. Our email is team@independence-money.com. We also have a YouTube channel. There's tons of videos in Nicaragua on there. We do post weekly videos as well. It's Independence Money on YouTube and Rumble. And then some people have asked if this recording is going to be sent out. I think Michael Fuller is going to work on getting this recording packaged and sent out to everyone on their email list as well. So you'll have the recording and our contact info.
Yes, and we will include the email address as a link when we send it out. So so people will be able to get a hold of you.
Yeah. So Mike, let's talk about that. Like if you're just exploring international, you've got these preconceived ideas or the people whispering in your ear, you got to get boots on the ground and see it for yourself.
Yeah.
Tell me about the discovery tours to both Nica and to Belize, and which one we can meet up with you on.
Yeah, well, I don't know the dates off the top of my head. I know that early January, I will be in Nicaragua for a discovery tour. I will be in Belize in early, maybe second week of February in Belize. I know you guys are thinking about coming down a little bit later. So obviously, if it works out that we're together in one place or the other, that's awesome. You guys are fun to travel with. You brought a great group of people the last time. And that's really it, right? Coming with other folks and enjoying the experience of being in a new country or new areas within a country is tremendous. But you hit the nail on the head, Nathan. Boots on the ground, eyeballs out, draw your own conclusions. I've written many articles over the years, perception versus reality. I just, it's so critically important that we allow ourselves to see what it is rather than having it being filtered through a news media or other institutions that have, a staked interest, right? And so when we can see it with our own eyes, with our own experience, we can draw the conclusion that's right for us. So my real recommendation is get the filters out of the way, see it yourself like you guys have, and we'll get some dates. We'll put the dates in there too, so people have the opportunity to come and join and have a great time as part of a group of adventure loving folks looking for ways to do some neat things overseas.
Yeah, and if anybody wants to see what that looks like, go on our channel, Independence Money on YouTube, scroll back to June. We did all the zip lining, the surfing, the cloud.
Granada, the colonial city.
Some of those videos.
Yeah, right.
Time walking. Shanae said January Nica is going to be January 7th through the 14th, and Belize is February 13th through 17th. So thanks, Shanae. And thanks to you and all the ECI team. You guys have just, know how to put on a good property development and really good tours for anybody that wants to participate in the discoveries.
But thank you for those kind words. And it really is a team effort. We got a great group of folks that get the job done day in, day out, and they do a tremendous job making sure it's fun and meaningful, right? So it has to be both. All right, well, we are at the end of the Conversations with Cobb. And I thank you, Nathan, Amanda, for joining us this evening, and Michael Fuller for helping to pull this all together. Look forward to the next time we're together. And in the meantime, if you have any questions, please reach out. We're all here for you. We're great resources, and we want to make sure that you find what you're looking for when you decide to move and do some things overseas. So, all right. Good night, everybody.
Good
Thank
night. Thank
you.
you.